Well, welcome to the Best of Investing on Talk 910. That's right. This is the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Rob Spinoza of RPM Mortgage and financial and investment advisor Mike Zaidlin of Madrone Investment Advisory. Mark Hunt is off today. Our phone number is 888-912-1190. You're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Vacations are free. Their only request a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme is songs about war. Let's see if you guys know what you're talking about here.
What are they good for?
Yeah, exactly. Absolutely nothing. Okay, our website is bestofinvesting.com. We're also on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon and Sundays at 6 p.m. I want to make a quick little announcement here. You guys ever heard of Celtic Thunder?
Yep.
Okay, so these guys right now, they're playing at, not now, but on March 3rd, they're going to be playing at the City National Civic, which is in San Jose. And Celtic Thunder, I always want to say Celtic, but it's not, it's Celtic Thunder, has also been hailed as Billboard's top world music artist. And tickets are on sale now. They're available online at Ticketmaster.com. Now, it's interesting because someone had sent me a YouTube video. I don't know if they sent it to me or just put it on Facebook or something. Okay, I want to hear this thing.
Right.
These guys were awesome.
Yeah.
I mean, it was amazing how incredible these guys are. So again, this is Celtic Thunder, and they're playing at City National Civic on March 3rd. Check it out at Ticketmaster.com. I definitely would love to see that show. Okay, so Rob, we're going to get right into you.
Oh, wow. Okay. Good to be back. Well, I thought, starting off the year for me anyway, January, new year in real estate. Everybody's wondering what's going to happen in 2015. How is the market going to stack up to where it was in 2014 and to a lesser degree where it was in 2013? And one of the articles I came across in CNN was 5 biggest threats to the housing market. And I thought, well, gee, we can probably, the 3 of us can comment on all of these with some insight. And I would guess that all 5 of these points are probably ones that listeners have, fairly common ones. So I'm going to start ticking them off and see if it, listens to any comments from you guys. So number 1 is big investors cash out, meaning, all these guys that have purchased all this rental property, presumably to hold it and rent it out.
Yeah.
What's your take on that? Because
You said that they're cashing out?
Yeah, they cash out, so they sell the property. They figure, the value's up, and,
Well, it's interesting that I've heard that there have been a couple of sales where people are selling at cap rates of below 2. I don't understand the economics of that.
Well, Mike, any thoughts on it?
I do have some thoughts on that. I think that it's unlikely that people will cash out while interest rates are as low as they are. Because money always has to go somewhere, and if it's not in a real asset such as equities or real estate and interest rates are really low, the alternatives always determine where people do really put money.
Well, that's the thing, is the alternative. I mean, if they're cashing out, what do they do with the money?
Well, I don't know the answer to that, but what I'm looking at from the real estate side, from the mortgage side of things, is if these are single-family dwellings and they're coming back on the market, every agent in the Bay Area has been clamoring about inventory. There's nothing to sell. So I see this as a net positive if it does in fact happen.
Now, is it, you said are they doing rental?
It says right here.
Or is it all commercial?
Well, it says investors played a pivotal role in the housing market's recovery by purchasing hundreds of thousands of properties and renting them out. So I infer single-family dwellings, or at least, residential stock.
Now, Rob, are we talking about the Bay Area in particular? Or,
this is CNN Money, so let's assume that it's nationwide, which obviously colors things as well.
Just remember, when you talk to Rob, you can still look at the camera.
Hello, everybody.
Come on, this is a radio show.
It's a radio show for television. That's right. Very interesting. All right, whose cell phone's going
It's
on?
not mine.
It's not mine. Uber.
Well, I turned mine off. So
it's one of the listeners. Let's get on with the show.
Yeah, come on.
So number 2.
Cell phone off there.
Curiously, foreign buyers stop buying.
Okay. Interesting. Foreign buyers stop buying?
Mike, maybe you can comment about the strength of the dollar and how that plays into this?
Yeah, well, the dollar being strong is definitely going to keep people from being able to, foreign buyers from coming in to some degree, I think. On the other hand, that's offset by the amount of wealth probably coming over from China and India and other emerging markets too. That is helping, from what I've read, keep housing prices up as well and other commercial properties.
Well, it sounds like the entire world seems to be in turmoil, and everybody
Yeah.
wants to safety, and the United States seems to be the most safe.
Well, and I figured at some point in the show today we would be talking about where U.S. Treasuries are, how that relates to the mortgage market, and where interest rates are as a result of both. But it is an interesting dynamic now when you look at this, because it is one of the items on this list. It's number 5. I'll jump right to it. A sharp increase in mortgage rates. Guys, I don't see that on the table for 2015.
No, I mean, didn't they just get lowered again?
We're at 20-month lows.
Yeah.
I think the 10-year Treasury is now at 1.73.
Yeah.
I believe.
Yep. Yeah. And here's the other thing I see. Correct me if I'm wrong. The Fed has a dual mandate. The Fed, with setting monetary policy, they are aiming at 2 primary goals. One is maximize employment, and second is to keep inflation in check. I don't see inflation anywhere.
No,
in fact, with the oil move, I see it almost as a deflationary environment. Certainly, like you said, Edward, Europe, the rest of the globe right now is more inclined to be leaning on the deflation side of the equation. And the other component of it is, when we've been looking at these jobs reports, the top line number hasn't been all that bad. But in there's no wage growth. So
yeah, in fact, well, getting back to just real quickly with the deflation, if I'm not mistaken, I think I'm trying to remember if it's Switzerland or one of the countries basically is charging you to put money in the bank.
Oh,
it's
yeah.
a negative interest. It's a small one, but it's a negative interest rate. Or at least I don't know if it's still there, but it blipped down, but it's 0.
Yeah, there's a real worry in Europe of deflation, and that's why so much has been pumped into the economy now. I think it's not sure what the size of the amount of money being pumped into the European economy.
So essentially, a quantitative easing measure there.
Yeah,
that's what you're saying.
Exactly.
And we know what effect that had here in the United States with real estate, and that essentially was the savior of the real estate market, as far as I can see.
Well, the euro, I know it's been dropping. I don't know what is it at now?
It's at about 1.13 to the
Wow.
dollar, but there are a lot of projections that it's going to go to parity within a year or two.
Right.
From Goldman Sachs and Morgan Stanley, among others.
That'll be good for those people who are traveling to Europe.
Yeah.
As long as they're not going to Switzerland.
Yeah. Is Switzerland in Europe?
I'm not taking a stance on that.
Or Norway.
Yeah, but I mean, just like going to Rome,
right?
Or something like that. I mean, I remember some years back it was about $1.40 something.
It was up to $1.60 a couple of years ago, I think.
Well, wasn't it back in the throes of our recession? Wasn't it that people were converting their dollars to euros?
Yeah,
perhaps.
Supers.
Yeah, I mean, unless you got out of that, right? But number 3, incomes fail to keep up with home prices. We just talked about that a little bit. I see that a lot here in the Bay Area, because you'll talk with a young couple making a decent income, employed in technology or in biopharma or something here in the Bay Area, where we do enjoy almost 100% employment, and yet they still struggle to buy a house because the median home price is close to $1 million in a lot of counties.
I got a question. If someone has 2 jobs, is that 200% employment?
Get the fact.
I don't know if you have more than one full-time job, but
okay, I guess it's based on full-time.
If one individual has,
2 jobs.
we can talk about that later in terms of qualifying for a mortgage. I just had a borrower with that situation. It's quite interesting how that works. Yeah,
that's a good. That's a very good question. We should have had an email on that.
Well, maybe we will. Maybe someone will call in and ask.
Yeah.
And finally, number 4, lenders will be too skittish. So I'll comment on that. I'll take that one, guys. I don't see that being the case. I really see lending guidelines. I think in the last couple of years, I've been encouraged by the fact that jumbo money has come back. That means Wall Street investors see a value in it. Obviously, they're getting to pick and choose who they lend to, but that's been the way it's been now for some time, and I don't see that really changing. And I see guidelines expanding more than I see them contracting, which is very positive for housing.
Okay, tell you what, we're going to cut to our first commercial break, and the theme is songs about war.
Go ahead, shoot.
Okay, ready? Okay, the song Over There was from what war? There was a famous song called Over There. The first 3 callers with the correct answer are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. The song Over There was originally from what war? All right? Stay with us. You are listening to The Best of Investing. We will be right back. You with the glove. You're funny. Who do you think you are, Michael Jackson?
Yeah. Yeah.
So, Rob, when you are when you're looking down at your thing, make sure you're still
Okay.
like this because I'm noticing that I
Okay.
played with that a little bit.
Yeah, it's trying not to rely on it so much.
How you doing there, Mr. Kramer?
I'm doing fine.
You doing fine? This will be interesting to see. This will be the first time that's in a different
Yeah.
setting.
I'm going to change my weekend plans just to watch it.
Well, remember this one won't. He won't have this one in time
Yep.
for Saturday, unless he's
Okay,
really
no way.
really fast.
And they won't even allow me to put it in. You got to be a week ahead.
So, but it'll be on radio.
Yeah. Oh yeah.
Yeah,
This-
radio.
this
What is
will-
it, noon now, or is
Yeah,
it
it's
early? Noon? Okay.
And then I'll have the YouTube one up pretty
Saturday.
soon also,
Okay.
in case you want to check the YouTube part. Okay, ready? I want to. I'll get into this one article about renting is now twice as expensive.
Oh, I had-
as
Okay,
You
yeah.
wanna do it?
I know. I didn't. Go ahead and do it because I just took.
you do it.
I was going to print the same one out. That's
I
what.
always like to help our co-hosts.
I think I made it happen.
Ready? Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my co-host Mike Zalin of Madrone Investment Advisory and Rob Spinoza of RBM Mortgage. Mark Hoff is off today, and we miss him. Okay, here is our first trivia question. We asked about songs about war. The song Over There was from what war?
Well, I would guess World War I.
I'm gonna.
That is correct. And World War I, remember, over there, and then it was resurrected actually again for World War II. Very good, guys.
Nothing worse than a recycled war song. Should be outlawed. Get your own song.
Rob, now you and I were sharing this article, but I'm going to give you credit for it.
Okay.
About renting being twice as expensive.
As rents all over the U.S. continue to soar upwards, online real estate database Zillow has recently found out that renting a home is now twice as expensive as buying one. Wow.
Well, you know, that gets back to your first point, Rob, about what could end one of the threats to the housing increases with offloading of big collections of homes is that a sensing that prices have reached a peak.
I hear frustration amongst renters all the time. What tempers that frustration is down payment, because that's really that's the crux, right? I mean, if you have a job and if you can assess your affordability per month, and I have this conversation with first-time buyers all the time, then the real question becomes how much can you put down? So what we find here in the Bay Area, most of our counties have a conforming and an FHA loan limit of $625,500. Okay. FHA will permit a down payment of 3.5%. Conforming will now permit, not on the jumbo conforming size, but on the 417,000 conforming variety, 3% down. That just came back. So buyers do have some ways in with minimal down, but obviously a counterbalance to a minimum down payment is you're now carrying a larger loan.
Sure.
So you have to qualify for more.
But again, the interest rates are pretty low. Now, good question for you.
Yeah.
I know that sometimes with housing, that people are getting very frustrated as buyers because they're getting outbid.
Right.
Is that going on in the rental market too?
I don't know.
There's a
That's
bunch
a
of
good question.
You know what I mean?
Yeah, like they put in an application and they get turned down. Right. Right.
Well, I would think that it goes to financial credibility.
Yeah.
Well,
how many people are putting in for
And the competition.
the competition for that.
You know, and certainly too, what we're seeing here is obviously you've got the down payment equation, but I think a lot of folks benefit from making the foray into finding out about home financing, because I think a lot of people just think it's impossible to buy without a 20% down payment. And here in 2015, it always strikes my ear as funny when people think I'd like to buy, but I don't have 20%.
Okay, what do you have to do to qualify for FHA? A minimum of 620 FICO, right?
That's correct. That's correct.
Is that it? I mean, you don't have to be like a
Well,
veteran or anything.
No, you don't have to be a veteran. Good point. So a VA loan it requires either service in the military or a relationship. You need to be a spouse of a veteran or something like that. But FHA is anyone who will qualify for FHA's parameters, and they're fairly lenient. FHA will permit debt ratios that far outpace PACE conforming ratios. So sometimes, what I like to say about FHA, to cut to the chase, is FHA is a loan of necessity. You get an FHA loan if you don't have an option for getting a conventional loan. Conventional loan's a loan of choice.
Okay, are the rates higher for FHA?
No, actually, FHA's rates are lower,
So then,
but you have built-in mortgage insurance on an FHA loan.
and how much does that add, basically?
Well, on a typical Bay Area transaction, that could easily add $300 to $400 a month to your monthly payment.
Depending upon how large your mortgage is,
Right.
so many basis points. And then effectively the insurance is just if for whatever reason you don't pay.
Correct.
Okay.
What you're doing when you get an FHA loan, you're paying two forms of insurance: UFMIP, which is upfront mortgage insurance premium. That is 1.75 of the loan amount tacked on to the loan balance, but not added to the loan to value. Okay.
Okay.
That goes in when you originate the loan, and then secondly, you have your MIP, which is your monthly mortgage insurance premium. That was recently lowered. That was increased in 2013, I want to say, maybe 12, to an absurdly high level that basically marginalized FHA entirely. Now that's been reduced again, and it's at least bringing FHA back into the picture.
Well, I remember in the old days that because I remember years ago when I owned a condo and I had to have PMI.
Right.
That as soon as you could prove to them that the value had increased enough, I think it was so that it was less than 80% LTV,
Correct.
that they would get rid of the PMI. Is that still the case?
You want to jump in on this one? So the way that works, Edward, is that if you have an FHA loan, you can't get rid of the mortgage insurance in many cases at all. Okay, it's going to stay there for the life of the loan. On a conforming loan, however, if you get if you get mortgage insurance, then the homeownership equity protection. No, that's not true. It's the I forget which act it is, in 1998 or something like that. Basically says the lender must remove the PMI when you reach an amortization of 78% of your original balance. However, with a satisfactory payment history,
So no late pays.
no late pays,
Okay.
you can remove it when it hits 80%. What we have found in real world terms is that satisfactory pay history is about 2 years. Okay? So if you have the equity, you've maintained the mortgage in good standing, and you've been paying timely for 2 years, you can.
Okay, so I mean that to me is reasonable.
Absolutely.
Now the risk that the bank or the an FHA takes is that if you have plummeting prices afterward, oops.
Right.
I mean they can't
put it back on.
put it back on.
Right.
Exactly.
Rob, what about FHA loans and refis?
So FHA loans, FHA has a mechanism called a streamlined refinance. You can do that sometimes even without an appraisal. If you do that you can't do it before 6 months have elapsed. And if you do that within the first 2 years, they will prorate the UFMIP. Okay. The thing about FHA that's kind of interesting is that they have a net tangible benefit worksheet that the loan you must meet a certain reduction in payment, otherwise the FHA won't allow you to go back into a new FHA loan. You can refinance out of an FHA loan into any other loan type. They can't do anything about that. So if you were able to get a conventional loan, drop your mortgage insurance, and escape from FHA, which many people do when they have the opportunity, that's fair game.
Fair enough. Okay, tell you what, we're going to jump to a second quick commercial break. When we come back, I know Mike's got a lot of good stuff for us in the financial arena. Okay, so by the way, next week we are going to have another special trivia contest. So not this week, but next week. And it's going to be for the Beachcomber Motel. Heading to the Mendocino coast to check out the Beachcomber Motel and Spa, Surf and Sand Lodge, and the Beach House Inn, all in Fort Bragg. So 3 different places owned by the same company. Check them all out. Experience in-room hot tubs, fireplaces, and ocean views with decks in one of the finest destinations near Glass Beach. Love that. Check out the beachcombermotel.com, surfsandlodge.com, or beachinn.com. Maybe we should do a Best of Investing radio show from that place. I can sit in a hot tub with a fireplace, ocean view. Yeah? All right, so that's next week. All right, so now we're going to go to our regular trivia contest. The theme is songs about war. Now, this one's a tough one. World War I song, the band played Waltzing Matilda, details an Australian soldier in what famous battle?
Ugh.
The tough one. The first three callers, and I will tell you that I am pretty sure that you guys have heard of this, all right? The first three callers with the correct answer are going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190, excuse me, to answer this question. World War I song, the band played Waltzing Matilda, details an Australian soldier in what famous battle? Stay with us. The Best of Investing will be right back.
I'm trying to think of the only battle that I know in World War One.
Really? Just which one do you know?
It's going fire. I can't think of the name of it right now.
That's not helpful.
Yeah.
I was going to say Gallipoli, but I have no idea. That's
Okay, so just real quickly, he keeps pointing over. So what happens is when you're talking to Rob, don't look at him.
Okay,
You
yeah,
talk
it's
to-
really
you
hard.
talk- You can talk to Rob and go like this.
Fine.
See, I'm talking to Rob right now, but I'm looking at the camera.
I know it's really hard, and so
From now on, I'm
But-
just going to,
but
when I'm
really-
talking,
really,
I'm looking at the
it's
camera
a
and nobody
television-
else. That's my rule.
Yeah,
That's
yeah.
my rule.
it's a television show, and so I mean we know it's a radio show, and the audience can't see on the radio what you're doing, but the television can.
Yeah.
So even when you do, Rob, if you can just look like on your
Right.
audience.
Don't
yeah.
ignore
Well,
Kramer.
yeah, I'm trying to
He
get
loves
the mic and you at the same time. So okay, maybe that's
Yeah.
better.
Yeah.
Okay, I'll do that.
It's
Yeah.
like an Olympic event.
Yeah.
Yeah, it is, and it feels awkward, you know, but it'll rub on you.
I'm
The right
thinking
way.
of,
Well, we'll let you guys answer. You know.
I'm trying to think of the name of that.
And the Australians were only in a few.
Yeah, that's true too.
The
Australians.
West,
I don't know.
what was it?
The Western Front.
Yeah, all quiet in the Western Front. That's a slower one.
I keep thinking Maginot Line, but that's not the battle.
Battle of Gettysburg.
Yeah.
Battle of the Somme. Battle of the Marne.
Battle of the Somme. That's what. Yeah. Okay.
Okay, you guys ready?
Yep.
All right. We go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mike Zaglin and Rob Spinoza. Again, next week, Mark Hoff will be back with us. When we come to the second commercial break, we asked this trivia question about World War I songs. Or, excuse me, songs about war. This one happens to be a World War I song. The band played Waltzing Matilda, details an Australian soldier in what famous battle? Anybody?
Well, I can only think of a couple World War I battles. Battle of the Marne. Battle of the Somme.
Pick one.
I
I don't
have a horse
I can't
in this
even
race.
pick one.
I don't know.
Battle of Gallipoli.
Oh wow! He
He
said it during the break.
He did say it
I
during the break.
want partial credit for this
Yeah.
one.
Okay, we'll give you partial credit. Okay, so
That's
Mike-
great, Mike.
And I'd like 4 days of wherever.
Yeah.
Exactly.
It would help ease my pain.
Yeah. Okay. Now, Mike, we promised the audience you had a lot of good stuff for us.
Well, I had made a list of the 10 things that I think all investors should be thinking about all the time when they're investing. One is fees. What am I paying for my investments? I have clients come in who I would say 99% of them have no idea of what they're paying for their investments. Now, maybe that's a little bit self-selecting. The ones who do know may not be coming in to see me because they've already solved that part of it, but it's always a possibility. But the ones that do come in, the first thing I usually do is sit down with them with their portfolios and just run through their fees with their existing portfolios. And it's usually pretty shocking. Most of the time they're not in low-cost index funds. Most of the time they're in high-cost mutual funds, many of which have load fees that can often be 5%. So imagine having paid 5% for an upfront investment, which is about a year's worth of returns generally, and not really being aware of it. I'm sure it was disclosed, but it wasn't in their consciousness or their memory. And then in addition to that, they're also paying anywhere from 1% to 2% for their mutual funds. It's easy enough to check. You just go on Morningstar, which is what I do. But then you've got to sort of add up a couple different categories. One is the expense ratio, and then in addition to the expense ratio, you have to use the turnover of the fund as a guideline because mutual funds tend to turn over anywhere from 70 to 200% of their portfolios in any year. And that leads to transaction costs.
fees.
Exactly.
Right. Okay.
And in addition to mutual fund costs, if these mutual funds are held in a taxable account, the other issue is the taxes generated from all that trading, and so that generates a lot of long-term and short-term capital gains that, in my opinion, lead to another thing investors should be talking about, which you're thinking about, which is the impact of taxes on their investments. The whole idea really in investing is to defer tax as long as circumstances dictate, and for the most part, circumstances dictate that you do it for as long as possible. One exception might be if you're going to sell an investment and you're going to be in a higher tax bracket next year, then maybe you don't want to defer it. But for the most part, from 95% of the people, 95% of the time, you want to defer taxes because it's the equivalent of an interest-free loan from the government. It's a really important part of investing, and investors focus much too much on pre-tax returns and not enough on after-tax returns. It's harder to calculate.
Good point. Okay. Yeah. So you said that was number one.
Well, that was 1, 2, 3, 4. No,
oh,
yes, it was just one.
Oh, just one. Okay. And let's see here. Can I ask you the email question we got?
Sure.
And then we'll get into some of the other stuff. So here, an email came in for you, Mike. It says, I seem to pay too much in taxes on my Social Security earnings. What advice do you have for someone like me so I can avoid paying taxes on my Social Security?
Well, of course, that's very situation specific. If you are being taxed on Social Security, one thing you might want to think about is, well, first of all, if you have $500,000 a year in income, you're going to be paying tax on Social Security. Social Security is taxed based on something called the provisional income formula, and so if you're already have reached what's the 85% level for Social Security taxation, which I think is around $100,000 combined your total combined income, you're already going to be not much you're going to be able to do about that. But most people do have a lot of flexibility in terms of how much tax they are paying on their Social Security, depending on their income. So one thing to think about is, what are my other taxable sources of income? Is money being taken out of an IRA that's excessive, that's higher than your required minimum distribution? Well, that could cause you to go from the 0% Social Security bracket to the 50% to the 85%, and maybe you're not aware of that. So,
what about if they all their income comes from muni bonds?
Yeah, if all their income comes from muni bonds, I can't off the top of my head remember whether that if it's coming out of a taxable account. I'm not sure.
Well, if their income is from munis, it would be tax free. But if I remember correctly, I think the formula adds that back in.
I believe it does. Yeah, I believe
it
does.
That may help the income tax portion, but not necessarily the Social Security portion that gets taxed.
Now, to your point, Edward, one thing to consider is, and this is true a lot of times in financial planning, is it's not, once you're at the point where something's happening, it's often a little late.
Too late.
The better point is 10 years, 20 years earlier. So, for example, if you did have to take money out of your IRA, but you could have been at a point 20 years before where you could have done a Roth conversion, the money coming out of the Roth conversion would not have made your Social Security taxable any more than it already was. And so one thing to think about with a Roth conversion is what is the real incremental tax of a Roth conversion if I'm going to be able to not only avoid whatever my normal marginal tax rate would be on withdrawals, but avoid having some of it cause my Social Security to go from a 0 to a 50% tax bracket. And so oftentimes that dollar coming out of an IRA can have a much higher marginal tax than it would when you were thinking about what just the marginal rate would be.
No, that's a really good point, because a lot of times you just look at if I take $100,000 out of my IRA, I'll pay 40%, let's say.
Right.
But then you say, but you wouldn't have had to maybe pay on your Social Security. Now you do, and now that adds another 10 or 15% tax or whatever.
Exactly.
And most people uncover that when they go and file.
Yeah.
I mean, like you said, it's too late by the time you figure that out.
We need Catherine Harris, CPA, right here to tell us ahead of time.
Yeah.
Go see your CPA.
Well, and that actually leads to another thing investors should often be thinking about, and that is, when can I do a Roth conversion? What are my opportunities? Sometimes people think, oh, well, I've made too much money this year. But what if you had a business loss carry forward, a business loss?
Right.
What if you made a charitable contribution? There are definitely different factors. What if you accelerated tax deductions? If you could, a little bit of planning could go a long way and allow you to make a Roth conversion. A lot of times people don't look for it because it's just not in their consciousness.
Okay, so you're giving us a lot of good information. I know you have a lot more stuff, but right now there are people probably listening going, I want to get a hold of this guy because I got questions for him. How do I get a hold of him?
That's what I'm thinking.
Well, I'm not that hard to find. I'm in the phone book. They can reach me at 415-785-4585. And my website is madronellc.com.
Okay.
You know what? I want to say one thing there, Mike, because you touched on it, and it's just a quick saying I heard this week, and I think it's a really, really good one. It's a Chinese proverb, and it says, the best time to plant a tree was 20 years ago. The next best time is today. So when you're
Exactly.
talking about a lot of
Yeah,
this
so it's
stuff,
never
like
too
if
late.
you didn't do it then, start now.
Exactly. It's never too late because you've still got, if you've got another 20, 30 years or 50
Right.
years, there's always something you should be thinking about, or your accountant or financial advisor, estate planner, somebody in your planning loop should be helping you
Well,
with
it reminds me, when someone thinks about, I can't go back to school, I'm too old.
Right.
And it's like, well, in 4 years, how old are you going to be if you don't
Yeah.
go back to school?
Yeah.
So
Exactly. 5 years old.
Good point.
that's it. Exactly. Okay. I'll tell you what, Rob. We're going to cut to a quick commercial break. When we come back, we have an email question for you,
Great.
and then I want Mike to finish up a couple things. Okay, ready?
Yep.
Here's our third final commercial break trivia question. Again, the theme is songs about war. Considered to be the most powerful anti-war theme to date, Edwin Starr won a Grammy for recording this anti-Vietnam War song. What was the name of the song? The first 3 callers with the correct answer won a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer this question. Considered to be the most powerful anti-war theme anthem to date, Edward Starr won a Grammy for recording this anti-Vietnam War song. What was the name of the song? Stay with us. The Best of Investing will be right back.
Was that Ringo's brother?
Yes.
No.
You're so funny.
It wasn't Handsome Johnny, was it?
I'm not saying anything.
See,
You
you
get
know,
to
you
guess.
give me a clue when I
You
said
get-
Gallipoli.
you get-
I feel,
I know.
come on. How many people here are going to come up with Gallipoli?
Yeah, I know, right? You get a free pass in
I mean,
life
you know,
on history.
Then
there.
he's just like,
Mike, excuse me, that was really good.
That was good.
Oh, thanks.
Yeah, with you and you looking and then.
But it still
and you
feels
in the
awkward
corner
to
is
the
great.
two of us. Trust me, because I
Yeah.
can read your body language and vice versa.
Yeah.
I'm waiting for you to look over at me, but
yeah.
I can't do it.
No, and then you're looking in the right way because in that corner. I mean, we're on a new situation here, but it's looking better.
I've done interviews before where the guy's got the camera and the other guy's asking me the questions, and it's the
Yeah.
hardest thing in the world because you just
Yeah.
keep looking at the guy asking you the questions,
Right, and you don't want to look at the camera, right?
and the guy at the camera is usually staring at you with this like blank stare. You don't know what
Yeah.
to do. You feel like a deer in the headlights.
That would be me.
Yeah, sorry, but
Okay, we got a nice long segment to go.
So if you want to get into it, I think if we have time in the segment, I just wanted to go over what you and I were talking about on the break, how I think the forecast for rates is lower this year. And we can talk about the
Yeah.
economic factors that
Sure.
will play into that. But
I think people are no longer expecting rates to go up this year.
I agree with you.
But the Fed can't fully back off
Yeah.
because they've already said they were going to raise them.
Yeah, yeah.
So now they just have to say, oh, we wanted to, but we couldn't.
They have to massage the language.
It can't be
in
their
that
fault.
statement.
They can't change their mind
Right, right. Although the last vote was unanimous. Yeah, I don't know if you noticed that.
on raising
Pol-
rates.
Yeah,
Yeah.
or the policy for this last statement was
So if they raise their rates, what? How much would they raise them?
quarter.
I mean, so what?
And you know what?
So
That actually might be a good thing.
Yeah, for
'Cause
one,
the- 'cause now they're
people
building-
stop waiting for them to do it.
And takes out uncertainty. And the second thing is it starts building some room to move. Because right now there's nowhere to go down. I mean there is technically, right? But not healthy.
I'm going to get into your email and then we'll go back.
Sure.
And how long is this one?
This is a long one, 19 minutes.
19 minutes. Okay, that helps me. And then we should, before I forget, have a talk 910 radio thing.
Oh.
Here. We used to
I used to have it.
Yeah. That would really be helpful.
I
Speak to Don, would you?
think I took it out because we're never using it because we're on the outside. Okay, here you go. Welcome back to the Best of Investing. Last time for this show, I'm Edward Brown, your host, along with Mike Zaidlin and Rob Spinoza, and Mark Ponk will be back with us next week. When we cut to the third and final commercial break, we asked this trivia question about songs about war. Considered to be the most powerful anti-war anthem to date, Edwin Starr won a Grammy for recording this anti-Vietnam War song. What was the name of the song?
Was it recorded by Kenny Rogers?
Gambling? No.
I'm gonna say war.
War! What is it good for?
Yeah. And I didn't know the question was
Yeah.
coming before when we were
Yeah,
talking
that's
about it.
it.
But yeah.
That's the
What was his name? I didn't even know his name.
Edwin Starr.
Edwin Starr?
And it was not Ringo's brother, as Kramer. I don't think it was. Okay.
We're gonna get fact checked. What is that one site? Or whatever where they go? No, you know.
Fact check.
Yeah.
Okay, Rob, we received an email for you. I thought was kind of interesting. Does constantly refinancing my house lower my FICO score?
Oh, good question. Happy to answer this one. If you refinance only with Rob Spinos at RPM Mortgage, no problem. Keep doing it. No, seriously, the way it works is this. When you make a mortgage-related inquiry to your credit, and you do that multiple times within a 45-day window generally, it counts as a single inquiry. A lot of people don't know that. So a lot of unscrupulous mortgage brokers will tell people once they apply with any institution, don't go out and have your credit checked again. Don't shop my loan. Don't do any of that, because if you do it, it's going to hurt your credit. That is patently false.
Oh.
The FICO model understands when you're shopping for a big-ticket item, and a mortgage would be considered that certainly. And lenders are making an RMCR, a Residential Mortgage Credit Report. 3 bureaus, and they're going to see that the inquiries happened within a condensed window, counts as a single inquiry, and you don't have any detriment to your score. Now, you get that opportunity once per year. Okay, so in a 12-month period, if you went shopping for a mortgage and you exercised the 45-day window and went to 2 or 3 different places, you're okay.
And is that just for residential versus, let's say, if you're buying a car at the same time?
Well, yeah. If you make a car inquiry during that window, that's a separate inquiry now, because we see that differently. Right,
okay. Which is smart. Okay.
Right, because they don't, now your use of credit is different than the model understands.
Got it.
Some other things to know about your FICO score when you're talking about inquiries, because the most common objection that folks will have when they go to get a pre-approval is, I don't want a lender running my credit report because it's going to hurt my score.
A hard pull.
Right, a hard pull. So understand that new inquiries to your credit report account for 10% of the total FICO score. Okay, just 10%. So let's take your example of you refinanced once with a lender, everything went okay, and let's say 6 months later you decide you want to refinance again. Rates warrant, and you decide, okay, I'm going to make another inquiry and try this thing again. Your lender that you worked with previously should be happy to tell you what your score was when you last went through the drill. And if you have a really strong FICO score, you essentially have nothing to worry about by making another inquiry, even in a 12-month period, or outside of the 45-day window, because you're exhibiting consistent behavior with being very creditworthy. The FICO model,
in theory, if you're refinancing, you're getting a lower rate,
correct,
theoretically,
correct,
and then that makes you even more creditworthy.
Yeah. So for those of you who are listening and who have maintained good credit your whole life, I don't think inquiries should be the impediment to making forward progress on something that improves your financial situation. Don't let that be the thing that stops you from doing it. Certainly, a website like myfico.com, which is the FICO model's consumer interface, is a great resource for information. Call me if you have questions about your FICO. I'll tell you all about how it works with that related to lending. And the only other thing I was going to say about FICO, when you start looking at, you just kind of jogged my memory on something else about how people think about FICO scores. What did you say before? You mentioned something about hard pull or
hard pull.
I can't think of what it is.
Pull.
Yeah, no, I can't think of what it is right now. But my point is, don't be overly concerned about the FICO scare when it comes to your credit. If you've always maintained good credit, I think it's perfectly safe to inquire.
Okay.
Yeah.
And so people are saying, how do I get a hold of
now?
this?
Now I want you to pull my credit.
Yeah.
You can reach me at 415-367-5959. I am with RPM Mortgage. I work out of the Mill Valley office. RPM-MTG.com is the website, and you can find me all over Google. Just type in my name, Rob Spinos, and I'll come up.
Also, you're on the Best of Investing.
Best of Investing website, yep, as well.
And what are rates right now?
So 30-year fixed rates on the conforming side are in the mid-threes again. So 3.5, 3.625 on the jumbo side, just about the same.
Okay.
Yeah, jumbo's really competitive right now.
We're going to jump back to Mike because we stopped after you gave the first couple of interesting investment tidbits. You have a couple more?
Well, the first thing I mentioned that investors should be thinking about was what their fees are. And closely, obviously, related to that is what is the impact of their fees once you even know them, which is, again, something that seems to be a lot harder to find out than people seem to think. It's actually very easy to find out what your fees are. But they're important because they have the potential to basically destroy a good chunk of your investments. typically, if we assume something like a 7%, 6% return, maybe over many years, and your fees are 2%, you're going to lose about 40% of everything you would have made over 25 years.
Wow.
Yeah, so
And that's major. And
so yeah, it's kind of interesting because a lot of times when you're listening to financial shows on the radio, you always hear about these financial planners and investment advisors, and they're either charging based on the fees, or percentage of assets, or they're selling load funds or selling annuities. And I'm thinking, audience is listening and they hear this guy talking about fees, bad. So I'm thinking, if I'm the audience, I'm kind of going, well, if this guy's saying fees are bad, it's like, what does he do for a living?
Right.
Well, there are fees and there are fees. I mean,
Okay.
fees have to be fair. They can't exploit the consumer. I mean, they can't take that much of your investments. Not if we're assuming a normal rate of return.
Right.
The problem is, it's not so much what the advisor is getting paid, although that's a significant part of it. But it's the fund fees themselves. So basically, when people go to financial advisors or investment advisors, they're often paying, say, 1% for advice, and then they're also paying another 1 to 2% for their funds. So suddenly they're up to 2 to 3% often, and so that's too much. That's just too much. I personally just charge a flat annual fee, tied to some degree to how much I'm managing, because there's liability, and also how much time I expect to put into it. So it's a number of factors, and so I just quoted a flat fee. It tends to be closer to about, I'd say, 0.5% if it was under an assets under management. But above and beyond that, the larger portion is actually going to be your funds. So if you're in low-cost index funds and you're paying 1/10 of 1%, that's going to be a lot easier than when you're paying 2% for mutual funds or 1.5%.
Right.
And so really, it's the combination of things. And ultimately, if you are paying someone for financial advice, that's fine. Obviously, that's how I make my living too. But you want to make sure you're getting more advice than just what investment should I be in.
Right.
Investing is just one small part of what someone really needs in their financial life. They really need to make sure they're getting advice on tax planning, retirement planning, estate planning, and just making sure that they're getting a lot more than just advice on which portfolio to own. Putting a portfolio together is actually quite a simple thing. It does get more involved if you have different types of accounts and you have Roths and IRAs, and then that leads to asset location issues. But there are hundreds of different questions that are going to be asked or need to be addressed over one's lifetime that go well beyond just the investment portfolio. And I think people tend to think, I just saw, the market's up 10%, and they're just focusing on what the return is. But it doesn't do them much good if that asset is in a taxable account and they're giving up a third of everything they're going to make. One economist estimated that each 0.25% in fees that investors pays pushes their retirement back by 1 year.
Wow.
Yeah.
Wow, that's incredible.
That's really something. But
Because you wouldn't even think a 0.25%. You just brush it off like, whatever.
Exactly.
I wonder if it matters, like if you made 20% versus 19.75%, or if it would be like looking at 6% compared to 5.75%.
Sure. Well, the higher your returns are, the less of an impact fees can have. However, we're in an environment where treasuries are paying 1.7%.
Yeah.
What's the impact?
So where you're going to go, right?
You're paying your advisor 1.5% for that. If you one study from the Department of Labor estimated that for every percent that 401k plan participants pay over 35 years, that'll reduce their balance by 28%. That's 1%.
So 1% over 30 years.
35 years.
35 years. Wow.
Would reduce their balance by an average of 28%. So fees are critically important, and that leads to another thing investors should be thinking about, and that's who are they getting their advice from? Is it from a fiduciary? Is it from someone who put in writing, I'm a fiduciary, therefore legally obligated to put your interests first? Or is it from someone calling themselves a financial advisor, but really a sales agent?
You know what's interesting on that too is because it impacts our industry. So you just brought to light a choice that a consumer has to make. In our industry, and the reason I'm bringing this up is how important it is for people to understand that, because in our industry, the CFPB and Dodd-Frank have taken the choice out of the picture. So they basically dictated what people in our industry can make and how we can make it, and they've eliminated consumer choice as a result. So with investing, you still have at your disposal the ability to make a choice and then act upon it without it being colored to a large degree by the CFPB saying, you can only do that.
Yeah, that's a really good point, Rob. You're right. The consumer in the investment financial services industry has a huge amount of choice, except that they often lack the knowledge to make that
Right.
choice because they don't really know. They assume that someone who's calling themselves a financial advisor is looking out for their best interests. But a financial advisor may or may not be. In fact, I don't even think there's a legal requirement you could put on. You could all be financial advisors today. I don't think there's any sort of a
Yeah, it's different if you're a registered investment advisor. That's a specific legal term.
exactly, that is. And as a registered investment advisor, I have to act as a fiduciary. I'd like to think I would anyway. But,
Yeah.
Well, I think that's one of the things that has been brought to light in our industry, and something I take very seriously is that we have any number of loan programs that are still available. You were talking about FHA and all that. And what a lot of folks don't know behind the scenes is how those loans relate to our income and lender credits and things like that are now forced into place by the CFPB mechanism. And a big part of what they have intended to do is to prevent us from putting borrowers into loans that otherwise cost more than they would have. As a result of that, it has taken away the ability for those who would not have done that anyway to properly match a person with a program without a lot of different hurdles to go through. So again, my point on that is that if you're working with someone who does put your interests first, you've identified that, good for you. In the financial sector, you still have the ability to do that. When you go into the lending environment, it's a very, very rough and difficult set of guidelines that you have to fit into to find someone that will actually act that way.
exactly, it's critically important.
There were a couple of other things that you wanted to touch on, weren't there?
This is a great list because it can go on and on. So
There are, but I'll just finish up with always know how your financial advisor is getting paid. The best advice you're going to get is when your financial advisor is getting paid only by you. Because if that's the case, they will have no conflicts of interest. They won't have a product list that's going to pay them higher commissions if they sell a certain product to you. So that is a critically important thing. There's such a high correlation between how well you do and whether you got your advice from a fiduciary or a broker.
Yeah, I've got someday I'll have to tell the tons of stories I've got about that one. And this is kind of interesting. I'm going to touch on this article because we're talking about negative interest rates. So actually, this was written by George Blackburn, who I've known him for a little while. He actually does mortgages, but it says here something extraordinary happened. Interest rates turned negative in Germany, Switzerland, which I mentioned, and Japan. In fact, the headline of a recent article in the Telegraph, a British newspaper, read, Europe's bond yields fall to their lowest level since the Black Death. What was that, 1666?
I don't know.
So it says here, suppose you're a trustee of an endowment fund for a large German university or a trustee of a pension plan. Your trust documents require you to keep 15% of your corpus invested in government, federally government treasury bonds.
Because of their security rating.
Exactly. Known as bunds.
Right.
In there. Okay, since the German national government is almost running a budget surplus, there's a limited number of these bunds. Other trustees want them for their own funds, so you're forced into a bidding war for them. When the bidding settles, you realize that you actually paid a huge premium for these bonds. Your yield over the next 5 years is a negative 0.007%. Basically, you're paying the government, German government in this case, to store your money for 5 years.
Yeah.
So can you imagine being a fiduciary and it says, okay, you have to invest 15% in bonds? It's like, yeah, but they're negative. Doesn't matter.
Right.
Well,
They're safe.
in the United States, the Uniform Prudent Investor Act was passed in order to prevent having to force a trustee to invest just in, say, treasuries, which had happened for many years before that. And now a fiduciary is able to look at modern portfolio theory and invest on a total return point of view instead of having to just buy income bonds that pay zero.
Well, interesting. I remember a story that's going back 20-something years ago where there was a gentleman who, I think was a doctor, and he had a pension plan. He was the sole decision maker for the entire plan. And he said, hey, I'm a fiduciary here, and I don't want to lose any of my employees' money. So he didn't put any money in the stock market. He just put in treasury bills and CDs. Well, his employees sued him for being too conservative, and he lost.
Wow.
He lost because they said, well, you should have invested a portion of it in the stock market at the time the market went up. Yeah, gee, what happens if he invests in the stock market and it goes down?
One thing about that too, Mike, that you brought up is that I remember hearing that on the financial talk shows when the U.S. credit rating was because they were saying this is a sky is falling moment because now all of these institutions have a requirement to be invested only in AAA, and now we're not going to have that.
Right.
So what happens?
That's really important.
Yeah.
So, Mike, again, how do people get a hold of you? Because
Sure.
there's just all this great information that you can share with people.
They can reach me at 415-785-4585 or on the web at madronellc.com.
And again, Rob, people have questions about mortgages.
415-367-5959 RPM Mortgage in Mill Valley.
Okay. Any last minute? We got about another minute and a half to go.
Yeah. I was just going to say to the conversation about trust investing. Now, fortunately, we do have modern portfolio theory, and it really allows a trust to be managed for both the income beneficiary and the remainder beneficiaries. Because in the old days, if the whole trust was just managed with, say, treasury bonds, then the remainder beneficiaries who were going to inherit the corpus later on would be going, well, wait a minute. We don't have any growth assets in those, so you're being unfair. You're investing just for the income beneficiary, usually a surviving spouse, instead of investing for us, and you as a trustee have a fiduciary duty to look out for all of the beneficiaries' interests.
What is a trustee to do?
What does a trustee do? And that's why the Uniform Prudent Investor Act was passed, and a couple other accompanying laws that have made it much more easier for the fiduciary trustee to be fair to all the beneficiaries.
But you know how people are with lawsuits and everything, and 20/20 hindsight, and they go, "Oh, you should have all been invested in utilities, or you should have all put it on red, or put it on the horses because this one won." Just oh my gosh, if you would have spent all that money on lottery tickets, you would have won. I always thought about that. If the lottery gets to like 700 million, can you, if you've got enough money, buy every potential combination? You're guaranteed to win.
Sounds prudent to me.
Yeah, but the thing is, it's in the aggregate. So you as long as nobody else wins, then you get it all.
Well, then if you got the money to buy all those tickets, you can take care of that other part, can't you?
Yeah, but I mean, if you're trying to do 100% guarantee to win.
Do we have time for me to ask Rob one question?
One quick question.
That is on FHA loans that you were discussing earlier, and you said the FICO credit score just needed to be 620.
It can theoretically be lower than that, but investors overlay that.
Are those still what we would call full doc loans?
Yes, absolutely.
Okay. Yeah. So you have a question. You have time to ask him a question, but he doesn't have time to answer it. No, he did.
Tune in next week.
Yeah, exactly. Okay. Here, thoughts for the day. Mark Twain said, "Whenever you find yourself on the side of the majority, it's time to pause and reflect." And Herbert Hoover said, "Economic depression cannot be cured by legislative action or executive pronouncement. Economic wounds must be healed by the action of the cells of the economic body."
He wasn't reelected, I believe.
Yeah,
far too harsh.
But in theory, he was correct. Okay. Tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. And thanks for joining us, Mike and Rob.
My pleasure.
Excellent
Great to be back.
information. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long. And that's a wrap.
Cool.
Good job, guys.
Good, guys.
Wow.